Thank you for joining me. I'm Justin Anderson of Anderson Griggs Investments, and I wanted to talk a little bit about judging your own personal investment performance. We have a lot of fear as people that are putting money out there at risk and trying to earn a rate of return, especially people who have their retirement plans and you don't have a lot of guidance there. You're always wondering, am I doing the right thing? Am I earning what I should be earning? Am I losing too much? Because you have to remember, investments fluctuate. They go up and they go down. As a money manager, if I wanted to actually tell the world what my rate of return is in my clients' portfolios, I have to follow a very, very rigorous procedure. Tons of oversight, formulas, calculations, and they involve a lot of factors. When money goes in, when money goes out. The ultimate rate of return is actually after taxes, it's after cost, how much you pay the professional who manages the money. That's all factored in to get the last bottom line on how well you're doing. So when you just look at your 401k at work and it goes up, one of the things you have to remember, you're putting money in each paycheck. So even though it's going up, it may not be going up as much as it should if you were doing things different. We understand that it's kind of hard to factor all this in, but you need to really look at things and decide, what are you comparing against? Most people, again, I think when they're trying to compare how well their investments are doing, they look to either the news, the stock market returns that they see daily on the news. The S&P 500 is up 1%, the Dow Jones Industrial is up 1.5%, it's down 2%, and they try to judge against that. There's really no need to judge against the stock market. You don't own the stock market. You could try to own the stock market. There's ETFs out there, and if you put 100% of your money in there, that you could try to judge against that, but most people don't do that. They don't put all their money in the stock market and leave it. What they do is they put it in and they take it out. They try to time the market, and invariably they hurt themselves. Another thing that they use as a way to judge how well they're doing, they'll look at the list of mutual funds that are available in their 401k, and they see the one that does the best, and they feel that that's what they're supposed to compare against. So what they do is they look and they see this one did outperformed what they currently have by 10%, and then they make a switch because they think that's what they should have earned. So they switch to the best performing one for the previous year, and they do that year in and year out. That's also a mistake. Really, your personal benchmark should be your investment goals. So if you have a specific goal, you need $10,000 in 10 years, that's your benchmark. It's not how well the market does, it's not how well the best mutual fund in your 401k does, it's are you on the path to reach that $10,000 limit in 10 years. Now, what can we expect in today's current investment environment? Because it is based on what's available, where the markets are at today, how much bonds are paying. What can individual investor expect today? Based on our internal research at Anderson Griggs Investments, I would not expect anywhere more than roughly 6% for common stocks for the next year out. And that includes 2% of dividends. On your fixed income investments, your bonds, a good range for a 5-year investment of bonds at today's interest rates could be anywhere from -3% to +2%. And a lot of people, that might make them feel uncomfortable. Most people think bonds are, a good, almost riskless free investment. However, that range that we're looking at is -3% to 2%. So it's not a 10% number, which I've heard a lot of people say. If we all could earn 10% year in and year out on our investments, if you started with $100,000 and you worked your whole life, when you retired, you'd have roughly $6.5 million. I don't know many retirees with $6.5 million in their investment portfolios. So just bring those ideas down. It's really hard to invest. Consistency is what's going to rule the day. Thank you.